Let's jump right into it. Welcome to The Explainer. Today, we're zeroing in on a company that is quite literally standing at a profound existential crossroads. It's May 2026, and the entire green energy market is holding its collective breath as we watch the cinematic, high-stakes reality of Plug Power unfold. Look, this isn't just another routine financial review we're doing today. This is a full-blown battle for survival. So, we have to start by asking the multi-billion-dollar question. It's the exact question that's completely paralyzing retail and institutional investors right now. Are we looking at the ultimate green energy turnaround story? A company perfectly poised to absolutely monopolize hydrogen infrastructure? Or is this just another value trap, just waiting to crush traders who buy into the hype? To really grasp the gravity of the situation here, you just have to look at this number. $1.7 billion. That is Plug Power's trailing 12-month net loss. It's a massive, heavy number, and it signals a terrifying financial reality that's threatening the company's very existence. It's the ultimate elephant in the room, and honestly, we just can't ignore it. Section 1, the ultimate battleground stock. Okay, let's dive right into this. Plug Power is the ultimate battleground stock right now. They're totally caught in this tug of war between massive algorithmic short sellers on one side and highly hopeful retail investors on the other. To make sense of the chaos, we have to look under the hood at their Q1 2026 earnings. When these numbers dropped, they caught Wall Street completely off guard. Revenue jumped over 22% year over year, hitting $163.5 million. But, broad revenue isn't actually the real star of the show here. Section 2, the bullish turnaround signs. See, beneath those massive historical losses we talked about, there are some undeniable structural improvements happening, and these form the core of the bull case. Take the 30-megawatt Barrow green hydrogen project over in the UK. This project just recently reached its final investment decision, which means it is officially moving into execution. Plug is supplying 6 5-megawatt GenEco electrolyzers to produce 100 gigawatt-hours of green hydrogen every single year. That's going to cut the local Kimberly-Clark plant's natural gas use right in half. This is concrete, undeniable proof of real-world commercial traction. And that real-world industrial uptake? Well, it's driving a staggering 343% surge in their electrolyzer platform revenue. Now, this is a massive shift. Historically, Plug was known for selling hydrogen fuel cells for things like warehouse forklifts. But now they're selling the massive multi-million-dollar industrial machinery that actually creates the green hydrogen. They aren't just selling the fuel anymore. They are successfully selling the refineries. And this brilliantly illustrates why that specific shift matters so much. Just look at this gross margin recovery. Back in Q1 of 2025, their margin was a disastrous negative 55%. Today, they've shrunk that bleed all the way down to negative 13%. How did they do it? They achieved this massive structural improvement by internalizing their supply chain. They brought facilities in Georgia and Tennessee online to make their own liquid hydrogen, effectively cutting out those exorbitant third-party costs. Section 3, the cash burn crisis. Now, before we pop the champagne over shrinking losses, we have to acknowledge a pretty grave reality here. Celebrating an earnings beat completely ignores the massive structural hole this company is sitting in. On paper, Plug reports $802 million in total liquidity. Sounds pretty great, right? Well, actually, only $223 million of that is unrestricted cash. Think of unrestricted cash as the checking account that management can actually tap into tomorrow to keep the lights on. That remaining $579 million, it's legally restricted. It's locked up as collateral and only releases very, very slowly over time. Because of this severe liquidity bottleneck, we're looking at a genuinely frightening reality. At their current burn rate, Plug Power's standalone operational cash runway is less than 12 months. So in under a year, that checking account hits absolute zero. That right there is the ticking clock that has absolutely everyone on Wall Street sweating. Section 4, the DO loan lawsuit. And to make matters even more complicated, compounding legal and political threats are acting as massive institutional overhangs, which is keeping a ton of capital firmly on the sidelines. So here are the objective facts. In March 2026, a securities fraud class action lawsuit alleged that executives misrepresented timelines regarding a $1.66 billion Department of Energy loan application. Furthermore, amidst the transition to the new presidential administration and an ongoing federal review, Plug actually suspended activities related to that $1.7 billion DOE loan. That brings a very real risk of permanent termination of that low-cost federal financing. Section 5. June 2026. Make or break. So, with the federal loan on ice, lawsuits pending, and cash rapidly running out, we arrive at the absolute climax of this whole situation. Management has a desperate, calculated plan to reset that ticking clock. It's a critical asset monetization strategy. Basically, Plug has entered into an agreement with Stream Data Centers to sell their interest in the Project Gateway site in New York. This is scheduled to close by the end of June 2026, and it's set to bring in up to $142 million. Closing this deal is the ultimate survival test to extend their runway and avoid wildly diluting current stockholders. Let's move to and see how this builds, because this $142 million lifeline in June is quite literally the foundation of management's entire multi-year survival bridge. Step 1, secure the cash. Step 2, leverage it to achieve a positive EBITDA run rate, meaning core operational profitability by the fourth quarter of this year. And finally, step 3, reach full company profitability by 2028. But you have to remember, if that June deal fails, this entire multi-year timeline completely collapses. Section 6, turnaround or value trap. So investors are caught in this really intense tug of war right now. On one side, you have the deep intrinsic value from an operational turnaround and a seriously booming electrolyzer business. On the other side, the immediate peril of a severe cash crunch and pending lawsuits. But there is a fascinating piece of insider sentiment you absolutely need to consider. CEO Jose Luis Crespo recently purchased 37,300 shares of Plug Power at an average of $2.34. Crucially, he bought those out of pocket with his own personal cash. That is the ultimate signal of insider conviction. It really makes you wonder if he's looking at that June deal and knows something the doubting market doesn't, right? And that brilliantly leaves us with this final provocative thought. If Plug Power actually survives this June cash crunch, and if they somehow manage to hit full profitability by 2028, what happens next? Will they emerge as the undisputed standalone king of the green hydrogen revolution? Or, by proving that the unit economics finally work, are they simply making themselves the perfect cheap acquisition target for some legacy oil giant just waiting in the wings? Review the data, weigh the risks, and decide for yourself. Thanks for joining me for this explainer.